Good evening, social media world. Dave Huber here, and it is time for Market Monday. Blair is out. He's doing a training of some sort, and so I am going to be taking over just for this week. We've got a lot to discuss. There's a lot going on in the market. Of course, there's not much going on in the market today because today is national holiday, Juneteenth. Juneteenth. So we celebrate freedom on this day, right? For our Black brothers and sisters. And we know that when we become a part of the family of Christ, we are made a new race, but there is still much diversity in that race, and we celebrate that. So, Juneteenth is a fantastic holiday. My brother in law, Matt, actually has a birthday on this holiday. So, we do a double celebration on Juneteenth. It's pretty cool. But there's another type of freedom that many of you are currently pursuing through your stock trading, and that is financial freedom, right? That's more than financial security, because you don't want security necessarily. You want freedom. You want the ability to choose. You want options. And what we're going to look at today is going to give us some insight that could help us achieve that financial freedom. We've got to understand the market. If we're going to trade in it, we've got to understand it. So if you're on with me, go ahead and say hello. You can comment. There's a little bit of a delay. Love to say hi to you guys. There is, let's see, I think only about a 1 minute delay, but we're going to look at the news. How is the news playing on the market? Before we do that, I want to tackle what is the market doing? And then I'm going to talk about what are the news components and what we here at Tradeway expect to see in the near future, maybe the immediate and a little bit more long-term future as well. So this could help us make decisions with our trading. It could help us either get into trades if we think the market's going to go a certain direction, or it can help us get out of trades if we think it's done going in a certain direction. Remember, what we're studying here is the third leg. It's the third leg of what we call the trading table. There's three components to the trading table. And you'll learn about these if you come to one of our live events, like Step 1, Start Your Journey. Sometimes we teach them at the Trade Surge events if you've met us in Trade Surge. And the three legs to the trading table are fundamentals, technicals, and market tone. And we're actually going to dive a little bit into what we call market tone. We need all three legs of the trading table on the table when we trade. So it's very important, this piece called market tone. It's one of three very important pieces. So I'm going to pull up a chart real quick and show you guys what the market looks like. Again, like I said, feel free to comment. You can like, subscribe, hit the notification bell if you think anybody else wants to join in with us. When you do that kind of stuff, it spreads out. We'll be on for probably close to 30 minutes today. So there's time to get everybody else joining on this live with us. So here's the market. The market's been screaming up, right? And there's a couple of different schools of thought. Some people are like, well, we avoided a terrible recession and now we're in a new bull. From a technical standpoint, that's kind of true, right? Like it's not necessarily going to be sustained, but from a technical standpoint, we've really moved up quite a bit. It's very bullish market tone. However, there are a lot of warning signs in the market that we're going to be looking at and that are being discussed in the news. And those warning signs could mess up this chart. It could go from being a move up to a massive move down. Lots of people are still the opinion that we're not done with a down move in the market just yet. So what we're going to do is we're going to look at this briefly, and then we're going to go look at some of the news components together. So I'm going to make this a little bigger here. See if I can make it just a little bigger for you guys. That may be as big as I can get it. Okay. Well, so I'm going to zoom out. We're going to look at this chart on a broader basis. Now, beginning in 22, we had in pretty much the whole year of 22, we had a pretty good move down, right? Right up until the last quarter. The last quarter, it really didn't want to stay moving down. So from a traditional definition of a bear market, we had one, right? It's not nearly as bad as what it needed to be. It really needs to shake out a lot more. And we haven't had that happen yet. Why? Well, there's a lot of things playing in the news side of things. It's kind of got people excited. Uh, Probably the number one thing that is dominating right now, artificial intelligence. And if you don't know what artificial intelligence is, it is the next revolution in the economy. You know, you've had the industrial revolution, you've had the digital revolution. This is going to be the artificial intelligence revolution. What do I mean by that? Well, it's going to vastly change the landscape of our economy. Hey, Benjamin, good to see you on here. Yeah, AI, that's the thing, my friend. That's the thing. Um, it's going to vastly change the landscape of our economy. Why? Well, computers have really gotten advanced. They've gotten so advanced now that many of the lower end jobs that have always used a human to accomplish are starting to be automated through the use of artificial intelligence. So, what does that mean for the economy? Well, that means that a lot of people are going to lose their jobs to a computer. Now, this has happened before with the introduction of computers, right? The introduction of the digital age, but not really so much on a very massive or large scale. The reason being, the computer needed somebody to operate it. So, when we had the digital age come and there was this digital revolution, we had a lot of people who just needed to retool and relearn so that they could go from working previously non-automated jobs or non-digital jobs to learning how to use a computer and doing some of the same jobs that they had done in the past, but on a computer. So if you were able to retool and relearn back in the early 80s and late 70s, early 80s, all the way up through the 90s, you had an opportunity to learn a new skill set that would keep you in the labor force. Well, with artificial intelligence, it's a little bit different. Yes, there is going to be some retooling and relearning. There's going to be an opportunity for many people to say, okay, now I need to jump on the artificial intelligence bandwagon and learn how to, let's say, program artificial intelligence. That's one thing. However, artificial intelligence is also being taught to program itself. So it's really taking it a step further because now the retooling and relearning is also being done by the computer. This could vastly change the landscape of our economy. It could just be an absolute game changer for the labor force. If millions of jobs are automated, and I'm not saying that's going to happen right now, there's going to be a transition period, right? Just like with the computer, it took some time for mass adoption. That time frame will probably go a lot faster than it did with the introduction of the computer because people are not nearly as scared of computers. There is a little bit of fear about artificial intelligence, but people tend to get over technological fear a lot faster nowadays. They begin to focus more on the benefits and how they can make their lives a whole lot easier. So we might actually see a faster adoption of artificial intelligence than we did the computer. I would expect it. All right. But when this happens, when this adoption occurs, there's still going to be a transitionary phase where more and more people will begin. Yes, that's right, Benjamin. It'll take time. More and more people will begin to adopt this new technology. And so there will be a little bit of a time frame before it really starts affecting jobs in mass. However, once those jobs are affected in mass, what happens? Like, where do the people go? There's a lot of thought on this. Some people say, okay, it may be that artificial intelligence just completely replaces the need for humans. And in that case, you're going to have a whole lot of people who are just dependent on a government for handouts because there will be no more jobs. That could be the long term, right? That really could be the long term. I think what you'll start to see as artificial intelligence grows in popularity and in production and in application, adoption, I should say, you're probably going to see a lot of people start to push back against it, right? There's going to be a little bit of fear, a little bit of a pushback, and maybe even, for lack of better terms, a war, not like a war fought with guns and stuff, but a cultural war over artificial intelligence versus human intelligence. And so what you might begin to see is businesses start to say artificial intelligence free business, right? Or human resource dependency or something to that effect, right? Don't know how long that will last. The One of the most profound things about artificial intelligence is its ability to work very, very quickly and efficiently. Well, that means that a lot of remedial tasks, a lot of tedious type things will likely just be automated. Some tasks that people just don't enjoy doing, right? It's happening in some businesses, some of the forward looking businesses that are saying, hey, we just want to go ahead and adopt to be early adopters of artificial intelligence. I have a nephew who said that it's already affected one job opportunity that he had. He went and tried to get a job at a restaurant. The job was filled by a robot. So think about that. It is here. It's here and it's probably here to stay. So what does that do to the stock market though? Well, my father-in-law summed it up in a pretty simple way to understand it. Just today, I asked him, well, okay, what happens if you have this mass adoption of artificial intelligence? What happens if all these businesses can continue to output the amount of work that they have been doing and just eliminate humans from the equation? Profits would go up, right? So maybe the market doesn't crash. Well, he said that could be true, but now you've got a whole bunch of people who are out of a job, which means now they're not making money. And if they're not making money, they can't spend money. And if they can't spend money, they can't buy those businesses' products. So either way, you still are headed for a recession. And it could be an artificial intelligence induced recession. I doubt it though. There's way too many other things that are playing on the market that should have it going down right now. It's actually artificial intelligence that is currently propping it up. Everybody's excited about it. They're all buzzing about this new technology where computers can think for themselves, and they are completely missing the fact that there is still a lot of baggage in the market. We still have a whole lot of debt. We still have inflation that's too high. We've not reached our inflation targets. And basically, we've just got a lot of hurt that we haven't felt just yet. Some of you may be saying, well, no, we're feeling it already. I go to the grocery store, I buy groceries. They cost way more than they used to. I go to fill my gas tank. It costs way more than it used to. True. But there's a lot of room for it to get worse because inflation is still persistently high. Now, how do you fight inflation? Well, you make everybody start saving their money and stop spending their money. How do you do that? You put the hurt on businesses so they stop hiring people so that they don't have the money to spend anymore. Artificial intelligence, if it puts a lot of people out of business, could actually solve the inflation problem because now no one's going to be making money. And so they can't spend money, which means inflation begins to heal. However, then you've got problems in that businesses can't sell their products anymore. And it might be hard to get those people into jobs because if you have massive layoffs everywhere because so many jobs are automated by a computer, how many more times will a business look at a job and first go, how can we automate and duplicate with computers as opposed to hiring employees? It may be very hard to stimulate the economy after a recession. So let's talk, why don't we have a recession yet? Like what's happening in the news? Well, it's all artificial intelligence. It really is. I'm going to start just pulling up some articles here for you guys. Let me see if I've got it here. This is an article I'm going to share. Oops, I've got it in the wrong window so you guys can't see it. Let me move it over to this other window so y'all can see it. Let's just take a look at the chart first and then we'll go look at the news. Notice how we've broken out of the downtrend. We've been kind of in a roll pattern for a little bit, but we broke out of that roll pattern going up. Two schools of thought from a technical standpoint. One, is it a stair step pattern? It could be. It could be, but how long will the stair step last? Nobody knows, right? My father-in-law, David Mitchell, founder and CEO of Tradeway, is of the opinion that it very well could go down, most likely by October, if not sooner. Well, if it's going to wait till October, we could see some up move until October. But watch what happens in the stair step. First, you have a short period of up, and then you have a pretty long period of sideways. If that happens again, we could see very little movement all the way through for the next month, right? Maybe that's about a month right there from April. Actually, it's almost 2 months. About 2 months worth of sideways movement here. If we get 2 more months of sideways movement, that's July, August. Maybe we get another leg up. If something doesn't crash it beforehand, then you have September, October, boom. Then you're into new earning seasons. You're going to see a lot of overweight companies that will scale back their projections. And maybe we get a recession by then. But even if we don't get a recession until October, it's not likely that you'll get a whole lot more up move going into October, because we could just see more sideways motion. Let's see where we are from a technical standpoint real quick. I'm going to just draw some lines in here. I always like to start with some horizontal lines. Let's draw a horizontal line right where we're at and see if we're close to any other horizontal lines. Right in here, it's kind of weak. It's not a very strong horizontal line where we're at, so maybe we get a little more motion up. However, we had some really big movement down on Friday. Really big move. I look at maybe not price-wise, not a huge move down. It's a decent move down, but look at the volume. Look at the volume here. We do have a lot of volume on this move down, right? That's way higher than average. That could be indicative of a move down, or at least a stop in the move up. We may see it just move sideways. I would expect that this isn't just going to scream up tomorrow or the next day. We've got the Fed, who's going to be coming in and talking some more. There's talk of a pause. That's another reason why we haven't seen the market crash, because the Fed's talking about pausing. If you're going like, what is the Fed? The Fed is the Federal Reserve. That is our central bank. And what is it they're pausing? Interest rate hikes. So interest rates are the cost of borrowing money, right? So like when they raise the interest rates, they are making money more expensive. That's a good thing when you're worried about inflation. You want your money to be more expensive. That means it will buy more stuff. And so the way they fight that inflation is raising the interest rates. Well, they've been raising them pretty aggressively. In fact, it's been the most aggressive interest rate hikes since the early 80s. After Jimmy Carter's administration really messed up the economy quite a bit, there was an interest rate hike to fight the really bad inflation. And I believe it was Volcker. I believe that was the man who was in charge of the Fed at the time. Now it's Jerome Powell. And Volcker did a pause. He's kind of famous for this. He did a pause in the interest rate hikes, and it actually exacerbated the problem. It made it where interest rates went up again, and we had a little bit of a double dip recession. Well, we haven't really learned from our past, which is pretty sad. So we're talking about pausing interest rate hikes now because, let's face it, nobody likes interest rate hikes, right? The economy doesn't like it. It makes the economy crash. Will we pause? That's yet to be seen, but it's looking like they probably will, with a promise that we're going to raise interest rates over the next 2 quarters. And if that happens, then you're going to see a little bit more down movement in the market. The market's just happy right now because we're rumoring that we're not going to keep raising interest rates. Don't expect that to last. The last time we acted like this, inflation got more out of control, and then we had to get aggressive again with our interest rate hikes. That's likely what will happen again here. Similar volume, says Piano Tuning Artist. Thanks, Piano Tuning Artist, for commenting from YouTube. Similar volume on 531. Yeah, so end of May, right? End of May, we had some we had some similar motion there. That was actually probably the expiration of options. We had an expiration of options. Was it today or Friday? Maybe this coming Friday. Let's see. Today is the 19th. Yeah, I think it's one more Friday. We'll have an abnormal amount of options are going to be expiring. So that could really spell doom and gloom for the market. We could see this really start to crash. But what's being talked about in the news? Let's go look at some news articles. So this is from a technical standpoint. Here's what we're seeing. We're seeing some slight move up. I've got some lines drawn in here just because it's kind of trying to act like a little bull, right? And it's a pretty decent support line. So I'm just going to call that support for now. And we'll see if it will sustain that move up. If it moves up, it doesn't have much more to move before we have what could be the new resistance line. It's looking pretty strong here. We've got a resistance turn here, a pivot. We've got another pivot here. It used to be the pivot up. So this is a pretty strong spot. It could definitely set a new high for this year. It could keep doing this up until October, but I don't know, Benjamin. There's a lot of bad in the market still. So that's from a technical standpoint. Let's go take a look at the news, because that's really what we were going to look at together. So I'm just gonna bring up some articles. This is the first one. This is one that basically says, we were expecting a recession sooner rather than later, and we got it later, right? So why the recession never really hit, and what indicates that it still could. I'm going to give you a synopsis on this. Basically, it's going to talk about, and feel free to go and check it out on the street. If you go to Yahoo Finance, you're going to see this as one of the articles. You can click on it and read all about it. But I'm going to just, I've already read this article. I'm going to kind of give you the quick and skinny on it. Market participation is low. Essentially, what's happening is you have artificial intelligence is dominating the market in the news. People are excited about it. And the companies that are propping the market up are companies like NVIDIA and Microsoft, companies that are heavily investing in artificial intelligence. Now, in a new bull market, that would be great. You would actually have new companies leading the charge. And that is what it can appear as right now, because from a technical standpoint, we've kind of reached a technical bull market. But our market participation as a whole is very, very low. It's just the companies that are heavily invested in artificial intelligence that are really leading the charge. Typically, what you want to see is that you have some companies leading the charge, but you have a lot of companies getting back into the market. That usually signals a new bull market, maybe 2 to 3 years of up movement. We don't have broad participation yet. We basically just have the hype of artificial intelligence propping everything up. So it could be a fake out. Don't just buy in heavy or put all your 401k in saying it's the new bull. It could be a little bit premature. We'd really like to see a larger participation in the market, more companies getting back in to buying back their stocks and stuff. A lot of executives in their companies are selling their stocks. That's not a good sign that we're getting into a bull, right? Usually you see a lot of executives of these companies buying the stocks that they believe in of their own companies, and you see them acquiring stocks so that they can enjoy the ride up too. But you're seeing a lot of them still sell the stocks. So that's kind of a flag. Not a lot of market participation as a whole. We have just the leaders. So we're missing a component of a true new bull. Another part that this is talking about in this particular article is the fact that the yield curve inversion chart is still very, very inverted. What does that mean? Well, short-term bond yields are higher than long-term bond yields. A normal bond yield curve would mean that if you were to go and buy bonds, the longer you hold the bond, right? If you buy the long-term bonds, you should make a higher return because your money is at risk long term. In an economy where the people selling the bonds don't have much faith that those long-term bonds are going to keep going up, they tend to weight the returns or the yields on the short term. I'm trying to make this extremely simple because I know we're doing this is a very basic thing for many of y'all, but think of it like this. Bonds are debt, right? And the short-term debt makes a lot more money right now than the long-term debt. And that is backwards. It shouldn't be that way. That has been a very strong indicator of a pending recession since the 70s. Anytime you have short-term yields in bonds outpacing long-term yields, we say that the yield curve is inverted. In other words, it's kind of backwards. And there's a chance that we're going to have a recession ahead. It has been right 100% of the time since the 70s. And currently, that's what it's indicating, that a recession is still pending. We still have an inverted yield curve. So that's super bad news for the market, right? And so while we're seeing the market move up in the near term, it's likely just because there's lots of hype about this artificial intelligence stuff. What does that do for the big boys? Well, that gives them an opportunity to keep pumping it up so that eventually they can do what we call a pump and dump. Get people to buy on the hype of artificial intelligence and then dump the stock and let the retail investors be left holding the bag. You don't want to be left holding the bag. And so artificial intelligence is kind of the big news driver right now, but it is still just hype, right? We don't have broad participation in the market, and the yield curve is inverted still. So here's another article that is on Yahoo Finance. Powell speaks Fed. FedEx reports what to know this week. And I believe this is the one where if you scroll down, you got some economic data. Let's see if it is. I have it in my notes. Yeah, should be some economic data if we scroll down. Oh, maybe not. Let's see. U.S. markets will be closed Monday. That's today, by the way. With less than 2 full weeks of trading left in the second quarter and first half of 2023, all three. Oh, I actually didn't pull that up where you guys could see it. I'm sorry. Let me put that where y'all can see it. Here we go. Now I've got it where I can see it. Here we go. With less than 2 full weeks, I'm reading right here, left to trading in second quarter and first half of 2023, all three major indexes are currently sitting on gains, with the NASDAQ now up more than 30% this year, while the S&P 500 is up just less than 15%. Those are some big moves up. And if nothing else, I would expect to see some profit taking, at least from some of the retail investors who may have caught this move up. So the Dow Jones Industrial Average, which fell 9% last year against a roughly 20% drop for the S&P and 30% decline for the NASDAQ, is up 3.5% so far this year. Those are some pretty hefty gains in the first half of this year. The Fed left its benchmark interest rate unchanged last week. So there's the pause, right? We decided not to increase interest rates. All we're going to do is make inflation worse when we do that. This marks the first time it's done this since January of 2022. So this has been a year and a half of raising interest rates, and they've decided to pause for the first time. That's why the market's really happy. This is going to fake a lot of people out. It's going to make a lot of people say, yes, all right, this is finally over. They're feeling good about the market data. Time to buy in. And if you do that too soon, the big boys have an opportunity to pump and dump on you, and you get left with a really bad situation. So inflation data out Tuesday morning showed the Fed is making some progress towards its goal of bringing inflation back to 2%. What does that mean? It's not at 2% yet. It's not going to magically move itself down from here. Yes, they've made some progress, but they haven't reached the goal. So when they phrase it like this, inflation data shows some progress. That's great. We love to see progress. But then you expect to do nothing and it just fix itself. There's a trap there, guys. There's a trap. And so consumer price is rising at the slowest pace since 13 months. That's great. But will it continue to slow? On a core basis, however, CPI inflation showed prices rose 5.3% over the prior year in May, well above the Fed's stated goal. All right, so what does that tell you? They're spinning the news. They're saying we're making some progress, but it's still not what we want, right? So they're pausing. They're letting everybody have a breather from these interest rate hikes. But if you think they're going to reverse course and we're going to be in a new bull market, you might want to think again. So, as Powell said during the press conference last week, inflation pressures continue to run high. So there it is. Inflation is still too high, and the process of getting inflation back down to 2% has a long way to go. So that's coming straight out of the horse's mouth, guys. That is straight from Jerome Powell, the Fed chair. He is letting us know that he's not done raising interest rates. He's pausing, and the market's getting happy about it. That combined with the artificial intelligence hype is really going to get people all excited. Many people are going to jump in, and when they do that, you just might see a pump and dump. So don't get faked out. All right. Don't get faked out. Yes, this thing has moved up more than we had expected. We don't like that. We would really like to just be able to jump into some put options and make some money on the way down, but we let the market tell us what it's going to do. And so we are in a holding pattern right now. And I don't mean holding stocks. I mean holding cash. A lot of us are holding cash, waiting for an opportunity. Some of us are in inverse positions, right? So you may have inverse ETFs, which don't really have an expiration on them. So we just hold on to that. You take a little bit of an expense, but it's kind of a buy and hold mentality. Taking an expense while it's moving up in the near term. When it crashes, you get the payoff later down the road. I know that the AMPed program right now is kind of in a holding pattern of some inverse positions for this very reason. We're not going to get faked out like the rest of the world might when it comes to a false start. We don't want to get faked out in a false start of a new bull market. So what does that mean for you, right? So you're seeing some of the news here. I guess I'll share just a couple more before we get into some personal application. But here's another article right here. New shiny bull market could be a mirage, and Wall Street should brace for a big collapse after recent rally, warns Bank of America analyst. Why do they use this terminology? Well, they could just be scaring people out of the market or trying, but I think it's just a telltale sign. They know that this is going to be bad. And really, guys, a big collapse, I think it's really coming. I don't know when it's going to come. It could be like The Big Short. I don't know if you've seen The Big Short movie, which was kind of it's a movie about the 2008 financial collapse when the bond market just bottomed out. It could be something like that. It could be worse. I know we have some safeguards in place that may keep it from being worse. So it's not going to be the same. It's going to be different than 08. But there are going to be some things that make it feel like 08. We certainly have way more debt than we did in 08. And so what does that mean? Well, time will tell. But right now, even the analysts at Bank of America are saying this could be just a mirage, something that's just designed to make us think it's going to go up. There's one more news item that I wanted to share with you guys. Here it says Wall Street's recent rally has been primarily driven by tech mega caps. Why? They're all invested in artificial intelligence and enthusiasm over artificial intelligence. There it is. But fears of missing out on a broader rally are driving formerly doubtful investors back into the market. Okay, so now that's a really interesting concept. What does that mean? That means a lot of people were expecting it to keep moving down. When it moved up, many of us were like, we don't believe it. And it still moved up. This last leg up has a lot of people going, well, what if I miss out? What if it is the new bull market and I'm getting in too late? So now you have people who are fear buying. They're buying out of the fear of missing out. If that's the case, those are not pros. Pros don't buy for fear of missing out. They don't do that. They base their buying and selling on the numbers and on the data. So that right there is a very cool thing to see in the news when they're saying people are buying because there's a fear of missing out. That should clue you in to the fact that it's not the pros, it's the retail investors. All right. And that does not drive a market into a new bull. That's classic pump and dump, guys. So you got to be aware of who's actually doing the buying, who's driving the market up. And in this last move down, don't forget, I'll pull it back up. Leave this. I think I accidentally zoomed out. I don't know what happened there, but let's see. I'm back. Sorry about that, guys. What inverse ETFs do you suggest? Actually, Benjamin, I don't suggest getting into any inverse ETFs just yet because we could see a little bit more of a move up moving into October. So I'm back. Sorry, guys. I don't know what happened. Something kicked me out, but thanks for sticking around for me. I see quite a few of you are still on there. Hey, Mario, good to see you on here. So let me just show you here on the chart. Present, share screen. Here it is. Chart. Okay, notice that high volume on the move down. That is indicative of big boys. So while the news is saying that the retail investors or the people who are buying are doing so out of a fear of missing out, FOMO is getting them. You see that simultaneously on the chart, the big boys are selling, right? The big boys, which drive that volume way up, they are actually selling. So this is a classic pump and dump scenario. I think we very well may see this move up slightly or sideways for a while, but I don't think you're going to have a new shiny bull market to stay, right? It may just be here long enough to get more retail investors to buy in before the pros dump it. So you got to be aware of that, right? You got to watch out for that kind of thing. So practical application, what can you use now that you have this in your pocket? Remember these things. Interest rates are really truly what drives the market. News can drive it short term, but those interest rates, they're going to be a longer term indicator of which way the market's going to go. If interest rates keep going up, you can bet the market's going to start going down. Interest rates have been promised to keep moving up. It may be a pause now in the short term, which means now news gets to take over and drive it up just a little bit. Everybody's excited about artificial intelligence, but the longer term forecast is we're going to be raising interest rates to fight this inflation that's still out of control. So I would expect this to be a short-term move up, maybe for a few months. It has definitely already been a few months. It moved sideways a little bit. Then we got this little bump up. But notice every time it moves up, it's on lower than average volume. Anytime it tries to move down, we get bigger volume moves, especially these two. But even this one here was higher than a lot of the up moves. So there's a good chance that we see this start to move down in the near future. So practical application, maybe don't get into any up plays right now, especially since we've got this big move down on higher volume. That's kind of bearish. We may see it just move sideways, and purchasing an up play of any kind, like buying into stocks, doesn't bode well for something that's just going sideways, especially if you're going to do options. If you're going to buy calls, you're going to lose a lot of time value waiting for this thing to move up. So it's just going to go sideways. You're going to lose a lot of time value. Should I buy puts right now? Maybe a little bit premature for that, because it's certainly, while it moved down here, we haven't had a good retracement down in the market. We've had an up move and a sideways move. If it does that again, you're not really going to have an opportunity to make much money on a put just yet, or even an inverse position. So this is the kind of thing where we wait and see if the market's going to give us some new direction. What I'd like to see is, instead of it going sideways, it gone ahead and tries to move on down to support. If that happens, then that would tell me that it's running out of steam, and maybe we see it break support and start finally moving back down. So that's kind of what's going on. How do we stay on top of the market? On top of the market news, identify what is the main thing in the news. And that's pretty easy right now. Everybody's talking artificial intelligence. Well, that's great. In a new bull market, you want something new leading the charge. So that would be an indicator of a new bull market. But we also need broader market participation coming in behind it, and that we don't have. Plus, we don't want to hear the Fed saying we need to keep raising interest rates, which they are saying. So they're saying we need to keep raising interest rates. We don't have broader participation in the market. The labor force is still too strong. All of that spells doom and gloom for the market, and yet it keeps going up. What do we call that at Tradeway? We call that squirrely. And if it's a squirrel market, it's a great time to just be in a holding pattern. And I don't mean holding stocks. I mean holding your cash. Just wait. We call it a waiting pattern. And we wait to see what the market tells us to do. So there's the news, how to stay on top of it, identify the number one thing that's driving it, and then decide, is it truly is it a news item that should hold weight? And if it does hold weight, does it hold more weight than the underlying economic factors? Some would look at this chart and say, yeah, artificial intelligence holds a lot of weight. I would agree. Does it hold more weight than the underlying economic factors? In the near term, yeah. In the long term, probably not, right? We don't have broader market participation, and these guys can't drive it all by themselves. So I would expect that soon we get a move down. But we'll wait, we let the market tell us what to do, and then we just follow. Hopefully that's something. Are we declaring a squirrel market or we're just watching for it? Great question there, Aiden. You get a gold star for a good question there. I don't believe we have actually declared a squirrel market because we do have a little pattern in here that we can see. Also, if we bring up some moving averages, it's pretty clear that it's starting to bounce off some moving averages. So I wouldn't call it a squirrel market just yet, but there's definitely some squirrely tone, right? Like the news is really kind of negative while we have up movement. So that we're really starting to get leery of the squirrel for that reason. Yep, smart money is weight. Great observation there, Mario. And guys, thanks for joining us live here for Market Monday. I hope you've enjoyed this one. I hope it's given you kind of a little bit of an insight as to what's actually driving the market. And then, yes, that is correct. Chichipated is what this market is. It's kind of chichipated. You've been listening to Boyce and Christy McLeod. Yeah, it's kind of just not making much sense. But at the same time, it kind of is. It's making sense. We can make sense of the story. We know what the story is. It's that artificial intelligence is driving the market, and only because we've paused interest rates. As soon as we increase those interest rates again, the artificial intelligence is not going to overcome the underlying economic factors. So I think we will eventually see this go down. So just be careful, right? Be careful. You could do some short-term trades. If you know how to do a step 4 debit spread strategy, it's a pretty good environment for debit spreads when you get these little stair-step patterns. If you see it move sideways like we have here, right? If this happens again, it's not a bad place for some credit spreads. However, because we're just kind of teetering on the edge and it could crash, credit spreads could actually be pretty high risk because you don't want a whole lot of volatility on the on the credit spread, unless it's going to go, if you're doing a bear call, that would work. That could work because you want it to go down. And if it goes down, you're all right. And if it goes up, it's not likely to scream up from here because it already has. We call this an exhaustion move. It could just exhaust itself and then finally settle into a new down. But anyway, guys, lots of fun having you on here. Thanks for the participation and all the comments. Let us know what your thoughts on the market are, right? What are your thoughts? And we want to know what you think. We want to see what you say. And we want to see what you do as we watch the market play out. We will have an open market hours tomorrow, normal market hours. It was closed today. So I guess we'll see you again tomorrow. Tomorrow's Tuesday, right? Is tomorrow Tuesday? Yeah, tomorrow's Tuesday because today's Market Monday. So we'll see you for Tip Tuesday. Don't forget, Jeffrey, we'll do Tip Tuesday tomorrow. And then we have Word Wednesday. I'll be doing Word Wednesday on Wednesday. So join us live for those, and then we'll see you in the market. Y'all take care and have a fantastic afternoon.